Many new investors feel the stock market is a mystery, moving unpredictably. It often seems like a chaotic force, driven by unseen hands. But beneath the surface, there are fundamental forces at play. Understanding these drivers is key to making informed decisions. At its core, the stock market is a place where shares of public companies are bought and sold. These shares represent ownership in a company. Their prices fluctuate based on a continuous interplay of factors. The most fundamental force is supply and demand. When more people want to buy a stock than sell it, its price tends to rise. Conversely, if more people want to sell than buy, the price falls. This constant tug-of-war dictates daily price movements. Broader economic health significantly impacts the market. Gross domestic product, or GDP, reflects a nation's economic output. Inflation, interest rates set by central banks, and employment figures also play crucial roles. Positive economic news generally boosts investor confidence and stock prices. Individual company performance and news are powerful movers. Earnings reports, new product launches, and changes in management can cause significant price swings. Mergers, acquisitions, or even scandals can also dramatically affect a stock's value. Investors constantly evaluate a company's prospects. Events beyond economics can send ripples through the market. Wars, trade agreements, and even global pandemics can create widespread uncertainty or opportunity. These large-scale events often impact entire sectors or even global economies. They can shift investor sentiment rapidly. Human emotion plays a surprisingly large role. Fear and greed can drive irrational decisions, leading to bubbles or crashes. Herd mentality, where investors follow the crowd, can amplify market movements. Understanding this psychological aspect is vital for long-term success. Market indices are like thermometers for the economy. They are collections of stocks designed to represent a specific market or sector. The S&P 500, Dow Jones Industrial Average, and Nasdaq Composite are well-known examples. They provide a snapshot of overall market health. The S&P 500 tracks 500 large U.S. companies, offering a broad market view. The Dow focuses on 30 large, established companies. The Nasdaq is heavily weighted towards technology and growth stocks. Watching these indices helps gauge the market's general direction. Market movements often form identifiable trends. A bull market signifies a period of rising prices and investor optimism. Conversely, a bear market indicates falling prices and widespread pessimism. These trends can last for months or even years. Within these larger trends, there are shorter-term fluctuations. Understanding whether the market is in an uptrend or downtrend helps investors align their strategies. However, predicting exact turning points is notoriously difficult. Modern markets are heavily influenced by technology. High-frequency trading and algorithmic programs execute millions of trades in milliseconds. These automated systems react instantly to news and data, contributing to market volatility. They can amplify trends, both up and down. The stock market is a complex, dynamic system influenced by a multitude of factors. Economic data, company news, global events, and human psychology all play a part. While it may seem unpredictable, understanding these underlying drivers provides a clearer picture. Focus on long-term goals, continuous learning, and a disciplined approach.